Then in part C of the required, you need to assume that the external sales demand for the product produced by the Freud division increases to 3,500 units per annum. So let's change that on our diagram. The external sales demand is no longer 3,000 units, it's now 3,500 units. And in part 1, we need to determine whether the Darwin division should purchase the intermediate product from the Freud division or externally. So this is going to be very similar to the calculation that we performed in part A. So guys, most of the discussion around this calculation is exactly the same as part A, so I'm not going to repeat everything again. A lot of the costs you'll remember, or a lot of the cash flows, not only cost but also income, are not relevant to this decision because they are the same for both alternatives. They are the same regardless of whether the Darwin division purchases the components externally or if they purchase it from the Freud division. And once again, I have included the discussion for you over here. But please go back to part A if you are not sure about why I'm not taking certain cash flows into account. Everything was discussed in part A of the required. And the same logic applies over here. Now you'll remember in part A we said that if the units are transferred internally, so if the Darwin division buys the units from the Freud division, the Freud division will obviously have to manufacture these units, so their variable costs will increase as a direct result of the internal transfer. And the variable cost is 56 Rand per unit multiplied by the 2,000 units that are going to be transferred to the Darwin division. So that increases the cost of the company by 112,000 Rand. That's exactly the same as what we looked at in part A of the required. Also in part A of the required, we said if the units are purchased from the external supplier, the company is going to pay 95 Rand per unit for the 2,000 units, so it's going to cost the company 190,000 Rand. That is also exactly the same as part A of the required. The only difference that we have over here now is we have an opportunity cost. And if we go back to our diagram, the reason why we have an opportunity cost is the Freud division is not going to be able to sell 3,500 units externally if they have to transfer 2,000 units to the Darwin division, because their maximum capacity is 5,000 units. They can only produce 5,000 units. So if they have to transfer 2,000 units to the Darwin division, they will not be able to sell 3,500 units externally. They will only have spare capacity to sell 3,000 units externally. So they are going to have to sacrifice 500 units of their external sales. So we definitely have an opportunity cost over here. And that is the only difference in this calculation. So let's look at the calculation of the opportunity cost. We know that the maximum capacity of the Freud division is 5,000 units. The internal demand is 2,000 units. That's what the Darwin division requires. So they have available capacity for their external sales of 3,000 units. However, they would like to sell 3,500 units externally. So we have a shortage over here. They are going to have to sacrifice some of their external sales as a direct result of this internal transfer. So we definitely have an opportunity cost. If 2,000 units are transferred to the Darwin division, the Freud division will only be able to sell 3,000 units on the external market, and therefore there is an opportunity cost. All right, and how do we calculate the Rand value of our opportunity cost? Remember, the Rand value of your opportunity cost is always the lost contribution. So, how do we calculate contribution? Contribution is sales minus variable costs. So if we go back to our diagram, if the Freud division sells these units on the external market, the selling price per unit is 95 Rand and their variable costs are 60 Rand. Just be careful, I'm trying to calculate the contribution that they make on external sales. So the variable cost will obviously be 60 Rand because they will have to incur this 4 Rand packaging and delivery cost on external sales. So your variable cost is not 56 Rand. The variable cost on internal transfers is 56 Rand. The variable cost on external sales is 60 Rand. So in order to calculate the contribution that they make on their external sales, It's 95 Rand per unit minus 60 Rand per unit variable costs. So on their external sales, they make a contribution per unit of 35 Rand. So what is their lost contribution? What are they losing out on? They are losing out on 35 Rand per unit multiplied by 500 units. They would like to sell 3,500 units externally. They can only sell 3,000. They have to sacrifice 500 units of their external sales. So they are losing out on contribution of 17,500 Rand. So we do have an opportunity cost. We've calculated the Rand value of that opportunity cost, and this is definitely relevant to our decision. We can't just compare the 112,000 Rand to the 190,000 Rand and say it's definitely cheaper for the Freud division to rather buy the components internally from the Freud division. We can't just do that, because then you are not taking the opportunity cost into account. You have to take into account the fact that if this component is transferred internally, the Freud division is going to be losing out on some of their external sales, and that is going to increase the cost of transferring the units internally. So you take that opportunity cost into account over there, and now you can see the cost to the company if the units are transferred internally is 129,500 Rand. That takes into account what it will actually cost the Freud division to make the 2,000 units, and it also takes into account the fact that the Freud division is going to be losing out on some of their external sales. However, we can see the net effect is it is still cheaper for the component to rather be transferred internally. If the units are transferred internally, it is going to save the company 60,500 Rand, the difference between those two costs that we calculated above. So it is still in the best interest of the company as a whole for the units to be transferred internally, and they should not be purchased from the external supplier. So still part C of the required, so we're still assuming that the external sales demand for the product produced by the Freud division is 3,500 units per annum, and we need to now recommend a transfer price for the 2,000 units. So please remember, whenever you need to recommend a transfer price, you need to calculate a minimum transfer price, and you also need to calculate a maximum transfer price. So let's first look at the calculation of the minimum transfer price. Remember, you must study this formula. The formula is always exactly the same when you are calculating a minimum transfer price. Also remember that the calculation is done from the perspective of the transferring division, so the Freud division. We only look at the cost of the Freud division. We don't consider anything else. So what we do is we start with the variable cost of the Freud division. So remember, their variable costs are just 60 Rand per unit. We then deduct any variable costs saved on internal transfers. So 4 Rand is saved on internal transfers. We then add any incremental fixed costs. So are there any additional fixed costs that are incurred as a direct result of the transfer? No. Question is silent, so nothing. And the last thing we need to do is we need to add an opportunity cost. So you can see we start with our variable cost of 60 Rand per unit. We deduct the variable cost of 4 Rand per unit that is saved on internal transfers. We do not have any incremental fixed costs. However, in this part of the required, we do have an opportunity cost. And we have already calculated the total value of our opportunity cost is 17,500 Rand. So all you need to do now is we are trying to calculate a transfer price for 2,000 units. So you need to share that opportunity cost amongst all units that will be transferred. So to get a cost per unit, you just take your total opportunity cost and you divide by the units that are being transferred. So that you can get the opportunity cost per unit. I then have a minimum transfer price of 64.75 Rand per unit. We can now look at the calculation of the maximum transfer price. And the maximum transfer price is done from the perspective of the receiving division. So we are looking at this from the perspective of the Darwin division. Now remember, there were lots of different variations when it came to the calculation of the maximum transfer price. But please note, we're still dealing with exactly the same type of scenario in Part C of the required, because we still have an external supplier for this product. The Darwin division can purchase the product from an external supplier at 95 Rand per unit. So how do I calculate my maximum transfer price where I have an external supplier? I take the external market price and I deduct any variable costs that are saved on internal transfers. So my external market price is 95 Rand, savings on internal transfers, so there's savings on selling and transport expenses of 3 Rand, giving me a maximum transfer price of 92 Rand. So in this scenario, there was an external market for the purchase of the intermediate product. And that is why we are performing the calculation in that way. So we've now calculated our maximum and our minimum transfer price. So we know that the transfer price must fall somewhere between 64.75 Rand and 92 Rand per unit. And the final transfer price will be obtained through a process of negotiation. Lastly, we need to look at Part D of the required. We now need to assume that the external sales demand for the product produced by the Freud division increases to 5,000 units per annum, and the Freud division cannot purchase these units anywhere else as no external market exists, and we need to recommend a transfer price for the 2,000 units. So let's just make those changes first. Now the external sales demand for the Freud division has increased to 5,000 units per annum. And in addition to that, we do not have an external supplier for this product. So the Darwin division is forced to purchase the product internally from the Freud division. We need to now recommend a transfer price. So remember, once again, we are going to calculate the minimum transfer price, and we are going to calculate the maximum transfer price. So let's first look at the calculation for the minimum transfer price. So obviously, the variable costs of the Freud division are 60 Rand per unit, and they will save 4 Rand per unit on internal transfers. In addition to that, we know there are no incremental fixed costs. However, we need to consider if we have an opportunity cost. And the calculation is just below. So the maximum capacity of the Freud division is 5,000 units, and we know that the Darwin division requires 2,000 units. So that means the Freud division has spare capacity of 3,000 units for their external sales. However, based on the information provided in this part of the required, we know that the external sales demand is 5,000 units. So they definitely won't have enough capacity to make 5,000 units to be sold on the external market and another 2,000 units to be sold to the Darwin division. They're going to have to sacrifice some of their external sales if they transfer 2,000 units to the Darwin division. So we can see there, they want to sell 5,000 units externally. However, there's a shortage. If they transfer 2,000 units to the Darwin division, they will not be able to sell 5,000 units externally. They will only be able to sell 3,000 units externally. So they are giving up, or they are sacrificing 2,000 units of their external sales. So remember, the Rand value of the opportunity cost is the lost contribution. So what is the contribution per unit that they currently make on the external sales? Remember, contribution per unit is the selling price per unit minus the variable cost per unit. So they're currently selling the units on the external market for 95 Rand, and the variable cost per unit is 60 Rand. Remember, the variable cost per unit is 60 Rand, it's not 56 Rand. They only save the 4 Rand in packaging and delivery costs on internal transfers. On external sales, they will still incur that cost. So the variable cost on external sales is 60 Rand per unit. So the contribution that they make per unit on external sales is 35 Rand. So if they can't sell 2,000 units on the external market, they are losing out on contribution of 70,000 Rand. So if we include that in our calculation above, remember we are trying to calculate the transfer price per unit, so you can't just include the 70,000 Rand over here. We need the opportunity cost per unit, so you just need to divide by the number of units that are going to be transferred. To get the opportunity cost per unit. And that then gives us the minimum transfer price. Now, the reason why I've included this in your lecture notes is to show you if the transferring division is operating at full capacity. So the Freud division has a maximum capacity of 5,000 units and they can sell 5,000 units externally. So they are currently operating at maximum capacity and they don't have any spare capacity. If that's the case, when you calculate your minimum transfer price, it's going to be equal to the external price of 95 Rand minus any variable costs that are saved on internal transfers, giving me a minimum transfer price of 91 Rand. You can see that ties into this 91 Rand we calculated. And the reason for that is because the Freud division is operating at maximum capacity, if those units are transferred internally, the Freud division must be in the same position that they would be if the units were sold externally. In all of the previous examples, the Freud division had some spare capacity. So because they had spare capacity, they could afford to transfer those units at a lower price. However, now that they don't have any spare capacity, they need to make sure that the transfer results in exactly the same profit as if they had sold those units externally. And the reason why we deduct the 4 Rand is obviously they only incur the cost of 4 Rand per unit on external sales. So the external selling price must be higher in order to cover the 4 Rand per unit. On internal sales, they don't incur that cost of 4 Rand per unit. So on internal sales, they need the selling price to be 91 Rand for them to be in exactly the same position. So you can see just below, if the transferring division is operating at full capacity, in other words, there is no spare capacity, after taking the opportunity cost into account, the minimum transfer price will equal the external selling price less any variable costs saved on internal transfers. This is so that the transferring division is in the same position as it would have been if the products were sold externally. So that deals with my minimum transfer price. Now we need to look at our maximum transfer price. And now you need to be careful. In the previous parts of the required, we had an external supplier. So the Darwin division was not forced to buy from the Freud division. They could buy from an external supplier. Now think about this logically. Obviously, guys, if there was this external supplier over here and they were charging 95 Rand a unit, then the maximum that the Darwin division would be prepared to pay internally is 95 Rand a unit. If the Freud division says we're going to charge 100 Rand per unit, then the Darwin division is not going to purchase the product internally. Instead, they will rather purchase it externally at a cheaper price. So let's just go back to that previous calculation that we looked at in part C of the required. So in part C, when we calculated our maximum transfer price, this is when there was an external market. So the Darwin division could purchase the product from an external supplier at 95 Rand. And they would save, if they did purchase it internally, they would save 3 Rand per unit. So that's how we calculated the maximum transfer price. So think about it logically, like I said, if there's an external market, you will never pay more for the product internally. So the maximum transfer price is going to be the external price less any savings if you buy the product internally. However, we now do not have an external market. So if we go back here, I said to you we're going to come back to this later. So now there is no external market for the purchase of the intermediate product. The receiving department or division Darwin has no choice but to purchase the product from within the company. They have to buy the product from Freud because there is no external market. So obviously, if there's no external market, you can't just go and use the external market price because you don't have an external market price. There's two things that can happen if there is no external market. Either the final product is being sold in a perfect market, or the final product is being sold in an imperfect market. Now, what we are dealing with in part D of the required for this question is we are dealing with a perfect market. How do I know I'm dealing with a perfect market? The selling price for this product is 250 Rand. The selling price does not change with a change in volume. So because the selling price does not change with a change in volume, I'm dealing with a perfect market. Now, please note also, you are looking at the sale of the final product. So the final product that the Darwin division is going to sell for 250 Rand, that is being sold on a perfect market because my selling price does not change with a change in volume. In example 2, we are going to look at a situation where we are dealing with an imperfect market. So we'll deal with that just now. Right now, we are dealing with the final product being sold in a perfect market. So how do we then calculate our maximum transfer price? We take the receiving division's selling price, so the Darwin division's selling price, and we deduct all of the Darwin division's incremental costs, their fixed and their variable costs. I'll show you the logic now behind why we are deducting their fixed costs as well. But we deduct all of their costs in order to calculate the maximum transfer price. So you can see I have included the discussion over here. No external market exists, and therefore the Darwin division is forced to purchase the units from the Freud division, and we are dealing with a perfect market for the sale of the final product. Therefore, the maximum transfer price is calculated as follows. We take Darwin's selling price and we deduct all of Darwin's incremental costs, their fixed costs and their variable costs. So, Darwin's final selling price is 250 Rand. Their variable costs are 150 Rand per unit, and their fixed costs are 20,000 Rand in total. So for the fixed costs, you're just going to have to divide by the 2,000 units so that you can get the cost per unit, because we're working with everything here in units. And that gives me a maximum transfer price of 120 Rand per unit. How do I know that that's my maximum transfer price? Because this is the maximum transfer price so that the Darwin division does not make a loss. We can quickly prove the calculation. The Darwin division is going to sell the product for 250 Rand. They incur variable costs of 120 Rand. They incur fixed costs of 20,000 Rand divided by 2,000 units. And in addition to that, they also have to buy this intermediate product from the Freud division. So they also incur this transfer price over here. And we worked out that the maximum transfer price is 120 Rand. If you perform that calculation, guys, you are going to get a profit of 0. So that's why this is the maximum transfer price. It is the maximum that the Darwin division can pay without making a loss. So you can see at a transfer price of 120 Rand, they make a 0 profit. If the transfer price is more than 120 Rand, this division would make a loss. So that's why when you're performing this calculation, you take your fixed and variable costs into account. We are trying to calculate the maximum that the Darwin division can pay without making a loss. So we can just then wrap up this example. Our transfer price will then fall between 91 Rand and 120 Rand per unit.